John Higgins, Mortgage One. Happy Monday. So last week, the big number we were waiting for was the Fed's favorite gauge of inflation. That would be the PCE. And on the core level, you can see that over the last 2 months, we've come in at 0.1%. So, you annualize that, that's just barely over 1%. Now, 2 months certainly does not make a trend, and we're still not certain if the tariff announcements are going to add to this inflation number. But at the moment, the PCE numbers have been coming in well below what the market has expected, and honestly, probably what the Fed has expected as well. So we'll take it where we can get it, especially on the inflation front. That is a huge mover of mortgage interest rates. We'll keep an eye on next month's reading, but for right now, the trend seems to be our friend for sure. Let's take a look at what's coming up this week. The big moment will be Wednesday when the Fed announces whether they are going to cut interest rates or not, and give kind of their take on where things are as far as monetary policy goes. I've taken a snippet from the CME's website, kind of gives a forecast by people in the marketplace and what they're expecting, and a scant 1% of Fed watchers are looking for a rate cut. So don't think that the inflation numbers are going to move the Fed to cut interest rates anytime soon. Looks like rate cuts may be coming later in the year, but this month, don't hold your breath. When we look at the 10-year Treasury, we've talked about this number at 4.5%, and we're able to kind of maintain a stance just below it, but that doesn't really help our mortgage interest rates and home affordability. We're looking at a number that's, hanging closer to 4.5% than maybe that 4.2% number, which would be the next little line in the sand. If we get below 4.2%, that'd be outstanding news, but haven't been able to make any progress. And quite honestly, we're kind of stuck in this range here for a while, I think. What does that mean for our overall mortgage interest rates? Well, Freddie Mac's primary mortgage survey came in at 6.84. That's really not much change, maybe down a tick, but overall mortgage interest rates are stuck near 7%. We've talked about home affordability again and again until we really start to see interest rates break back towards 6%. It's been a tough market for our home buyers for sure. Well, let's talk about some good news as far as what's available out there for your home buyers. Just wanted to follow up on last week's announcement about the 6% interest rates for the non-DPA option that MSHDA offers. MSHDA, of course, has long been known as the best source for down payment assistance. And earlier this year, they did actually increase the sales price from $224,500 to $544,233. And they're actually going to index it to inflation. So that number will continue to rise year over year. What does that mean? That means more of our home buyers are able to take advantage of this program. We know at $224,500 in a lot of communities, there's just not a home out there. So take a look at the key highlights of this program. I mean, buyers can get up to $10,000. They only need a credit score of 640. It's available on all of our programs except for VA, so conventional, FHA, and the RD program. Buyers can get in for a minimum of 1% of the sales price, and there are some income limitations. Certainly check out my website, michigandpa.com, for more information on this great program, the income limits, the sales price limits, and all that. Would love to help your home buyers stop renting and get into a home this year. We'll give you an update next week after the Fed's meeting. If you have any questions on any mortgage-related items, I'd love to help your buyers. Until then, we'll talk to you next week.